Has Canada just entered a recession? The numbers that dropped today are shocking, and while one part of our economy is getting absolutely crushed, workers facing layoffs, plants shutting down, entire communities in crisis, another large group of Canadians might actually be celebrating. Yes, celebrating an economic contraction. Today, I am breaking down these jaw-dropping economic numbers. Which regions are in disaster mode and which Canadians could win big from this economic pain. Stick around, this affects your wallet directly, but whether you're winning or losing depends on where you live and what's in your financial portfolio. All right, here are the jaw-dropping numbers that just hit. Canada's economy contracted at a 1.6% annualized pace in the second quarter. That's nearly 3 times worse than economists expected. This is our first quarterly contraction in 7 quarters and the worst performance since the pandemic lockdowns. But here's where it gets interesting. This wasn't a broad economic collapse. Exports absolutely cratered, down 7.5%, with vehicle exports alone plummeting 25%. Meanwhile, domestic demand was actually strong. Canadians kept spending, kept building homes, governments kept investing. So what does this mean? We have an economy where international trade is getting absolutely crushed by tariffs and trade wars, but domestically, Canadians are still confident enough to spend money and buy houses. It's like having a store where a quarter of your customers disappeared overnight, but the remaining customers are buying twice as much. This creates a very unusual situation that's going to affect different regions and different types of Canadians in completely opposite ways. Now let's touch on the area of Canada that is going to get hit the hardest. Ontario's auto heartland took a devastating hit with vehicle exports down nearly 25%. If you work at Ford in Oakville or GM in Oshawa or any of the hundreds of auto parts suppliers across southwestern Ontario, you are feeling this directly. These aren't just stats, they are layoffs, reduced hours, and uncertainty about plant futures. For Ontario homebuyers in auto-dependent cities like Windsor, Cambridge, or Woodstock, be cautious. Employment in your region may weaken before it gets better. If you're house hunting in these areas, consider waiting for more stability or ensure you have strong job security. Alberta's steel and aluminum producers are getting hammered as well by US tariffs. Unlike oil, where prices are set globally, metals face direct trade barriers. Cities like Calgary and Edmonton have diversified, but smaller communities dependent on metals processing are vulnerable. If you're an Alberta homebuyer and your income depends on metals, energy services tied to steel production, or related manufacturing, tread carefully. However, if you're in tech, healthcare, or government, Alberta's housing market might offer opportunities as some sellers become motivated. And Quebec's aerospace sector, centered around Montreal, faces a complex picture. While not hit as hard as autos, any prolonged trade tension affects aircraft parts and defense contracts. Bombardier and the supplier network employ thousands across the province. Montreal homebuyers, aerospace jobs tend to be higher skilled with better job security than auto manufacturing, but watch for any major contract cancellations or production slowdowns. All right, if you're watching this and you're a home buyer or a current mortgage holder, this is where you need to pay attention. Interest rate implications for this. The market is now pricing in a much higher chance of a Bank of Canada rate cut. This economic contraction gives the central bank cover to lower rates even if inflation hasn't fully cooperated. For variable rate mortgage holders, this could mean relief. For those considering new purchases, lower variable rates improve affordability. But here is the catch. Strong domestic demand means housing prices aren't about to crash. Lower rates might actually support prices, especially in regions less dependent on exports. In export-dependent regions, think Auto Corridor in Ontario, metal towns in Alberta, lenders may become more cautious. In service-based markets like Vancouver, Toronto's finance district, or Ottawa's government sector, the impact is less direct. These markets might actually benefit from potentially lower rates without the employment disruption. If you're on the fence about buying, this contraction could create a brief window. Motivated sellers in export-dependent regions, combined with potentially falling rates, might offer opportunities. Now let's touch on the policy response. Governments and the Bank of Canada won't sit idle. Expect targeted support for affected industries, possibly loan guarantees for auto suppliers, support for metals processors, or aerospace R&D incentives. I personally do not like when the government over-intervenes in areas like this, as it can cause companies to become over-dependent on these government bailouts, but it will be what it will be. The Bank of Canada faces a complex decision as well. Cut rates to support the economy, but risk running up inflation again and reigniting housing markets in already expensive cities. They'll likely move carefully, but movement is most likely coming. For mortgage holders, this policy response timeline matters. Government support might stabilize employment in export industries faster than general economic recovery. Rate cuts might come sooner than traditionally expected, given the severity of the contraction. So here is your action plan. If you're buying in export-dependent regions, wait for employment stability signals. In service-based markets, monitor rate trends more than local employment. Everywhere else, focus on your personal financial stability over market timing. If you have a variable rate mortgage, this contraction makes rate cuts more likely. You can consider whether to lock in now or wait for those potential decreases. If you work in affected industries, build financial buffers. This isn't permanent, but the recovery timeline remains uncertain. And watch for these indicators: monthly employment data from the affected regions, any announcements of plant closures or expansions, and the Bank of Canada commentary on rate decisions. The bottom line is Canada's Q2 contraction was sharp but regionally concentrated. Your mortgage and housing decisions should reflect your local economic reality, not national headlines. This economic turbulence creates both challenges and opportunities. The key is understanding how global trade tensions translate to your local job market and housing situation. Keep watching these regional indicators, and remember, economic cycles pass, but good financial decisions endure. I'll keep tracking these developments and their implications for your mortgage. If you're looking for more content like this to stay up to date with Canadian real estate, please like and subscribe to the channel. If you enjoyed this video, you're gonna love this one as well.